Jerome Powell and the Federal Reserve are about to print a ton of money. It's going to make the 2020 stimulus look like ants. In this video, I'm going to show you why, but more importantly, I'm going to show you what you can do to preserve your purchasing power because your money is a representation of your time and energy. And when the Federal Reserve can create trillions of dollars out of nothing with strokes of a keyboard, they are making worthless your time and energy. So stay tuned to the end of this video, and I will show you what you can do to preserve your purchasing power in the wake of the biggest wave of money printing anybody has ever seen. Let's get into it. So this story starts here. Debt relative to GDP. Everyone knows the United States is in nearly $37 trillion of debt, but that doesn't tell the whole story because what you want to look at is debt relative to the productivity of the nation. So, for example, on a smaller scale, if you had $5,000 of credit card debt, but your income was $100,000. Well, if you go to $10,000 of credit card debt, but an income of $200,000, it's still the same relative to your income and your productivity. And so, in theory, if the United States can increase their productivity faster than the debt grows, they will be in a better position. Now, this since 1971, which, if you know what happened in 1971, leave a comment down below. The United States debt to GDP has been straight up. So the debt has been growing faster than productivity, economic activity, faster than we are able to produce goods and services and create value for the world to pay off that debt. Now, this quote is from the Treasury Secretary Scott Bessent, and he said very recently, "We can both grow the economy and control the debt. What is important is that the economy grows faster than the debt. If we change the growth trajectory of the country, of the economy, then we will stabilize our finances and grow our way out of this." So he's saying the exact same thing I'm saying here, which is they want to grow the economy faster than the debt. But what does this really mean? Because is it possible to grow the economy fast enough to pay down this 36.9, nearly $37 trillion in debt? Let's get into it. Let's look at the numbers. Let's see what's actually going to go on. Now, in order to understand this cryptic tweet from Treasury Secretary Bessent, which, mind you, is fifth in line behind the vice president in terms of hierarchy within the United States. So, this is a very powerful, very high up individual. What does this cryptic tweet mean? Well, there was another option besides outgrowing the debt, which was to have the debt itself grow at a slower rate. And how can you do that? Well, one way would be for the government to spend less money. Because right now they run a $2 trillion annual budget deficit, which means under the current fiscal conditions, the debt will grow $2 trillion per year. Now, we all know what happened with Elon Musk and Trump earlier this year. They created this big hoorah about Doge, and we're going to really tighten the belt on government spending. We're going to be conservative. We're not going to spend all this money. We're going to lower the deficit or maybe even run a surplus. Well, as we forewarned you on the show 6 months ago, that was an epic failure. And it's not to discredit Elon Musk or any of his brilliance, any of the things he's done as an entrepreneur, but it was a simple math equation, right? Look at these four largest budget items here. Medicare and Medicaid, 1.6 trillion, Social Security, 1.5 trillion, defense spending, 1 trillion, interest on the debt, 1 trillion and growing. This was a simple math equation. There was never not going to be a deficit. And so with cutting spending out of the equation, the only option left is, like Treasury Secretary Scott Bessent says, is to outgrow the debt. And this, for him, is a change in tune as well, because earlier this year, he was parroting the same Doge idea, let's cut spending. Now, that's out of the window. The cat is out of the bag. They're vocally admitting it that is not an option. They're going to have to grow, which is code for print. And I'll show you why. Now, right now, this is an important data point to understand. 3.362%. That is the average interest rate on outstanding treasuries, on the outstanding debt of the United States. So this debt, 37 trillion, has an average interest rate of 3.36%, which creates this net number here, 1 trillion in total nominal interest payments annually. Now, this number, the key here is this number is rising. And it's rising quickly. You can see just 5 years ago it was at 1.8%. Now it's at 3.3%. And when you just look at US Treasury rates over the past 5 years, you can see presently the 30 year is at 4.8%, the 10 years at 4.3%, the 2 year Treasury is at 3.9%. So whether the Treasury issues new debt on the short end of the curve, 3 months, 6 months, 2 years, or they issue it on the long end of the curve, the 10 year, 20 year, 30 year notes, the interest rates on the newly issued treasuries are higher than the current outstanding rates, which means their average interest rate is going to increase, which means this 1 trillion in net interest payments per year is going to increase. The rates are high and they've been struggling to get rates down. One of the goals of the Trump administration, one of their first orders of business was to try to get the 10-year treasury rate down. If we zoom in on this on a year-to-date basis, the 10-year Treasury rate started the year around 4.5 basis points, and now it's at 4.3. So they haven't really been able to do too much with that. Now they got it down bigly during the initial kind of tariff fear, but very quickly Treasury sold off again and rates have risen. So get rates down organically hasn't worked out too well. Now, here is a chart of nominal GDP growth. Now, this is kind of the key to bringing this all together. Nominal GDP has been growing at about 5% per year as of Q4 of 2024, and as of Q1 2025, about 4.7% growth per year. So when we look at grow the economy faster than the debt, right now rates are at 4.5, call it, and rising. And GDP growth is just over that, just a hair over that. So we're kind of very thinly treading this line where we're growing the economy faster than the debt. Now, this here is a lie. And here's a good example to show you why. In Q1 of 2021, nominal GDP growth spiked to 17%. Now, that was on a year-over-year change measuring from the quarter in 2020 where nobody was working. Now, that's just one minor example to show you kind of the flaws in GDP, but let's dig a little deeper. Let's unpack this further. Here is a chart of the consumer price index. Now, in theory, this measures the rate of inflation, the rate of change for prices in the economy. So, what Fred, which is the data bureau of the United States Federal Reserve, they measure the price of a basket of goods. Now, that basket of goods contains a lot of items, and based on my personal spending habits, a lot of the items in CPI are not representative of the things I actually purchase and the things you likely actually purchase on a day-to-day basis. For instance, beef, gasoline, rent, kind of your core spending items as an American, they don't make up the majority of the CPI and the goods in the CPI. So this is a very flawed metric when it comes to measuring inflation and the actual erosion of purchasing power of the dollar. A better way to look at that would be just simply looking at M2 and the year-over-year percent change. Now let me move my face here. The M2 money supply, so that effectively the kind of broad measure of the supply of dollars in the country, is kind of a better way to look at monetary inflation. And if you look here, this massive growth in M2 from 2020 to 2021, that looks a little conspicuous when you look at the nominal GDP growth, right? It's like, did we actually grow? What is this? 10, 15, 17% year over year? Or did they just increase the currency supply and the unit of measurement for GDP got distorted? That's the key here, right? They didn't actually grow the economy 17% year over year on a real basis. But if you were to subtract from CPI, which gives you the quote unquote real growth, what they do is they take nominal GDP subtracted by CPI to get a sort of a measure of inflation adjusted growth. That's going to illustrate a higher economic growth rate than when you subtract for M2 growth, which is, as we've demonstrated here, is kind of a more representative version of inflation. So all of this is to say they need M2 to rise because they need nominal GDP to rise because interest rates are high and the debt is high. And as Besant said, we need to outgrow the debt. And outgrow the debt is code for money printing. M2, which this is a year-over-year percent change. If we look at it just in raw terms in billions of dollars, you can see historically it has been straight up. Now, they tried to get fiscally conservative in 2022 when Jerome Powell turned hyper hawkish after the money printer go burr memes got under his skin, but it was inevitable. This M2 here had to continue its upward trend because of this right here and because of debt to GDP. Now, action items. This right here is a chart of the DXY, which is the dollar currency index. This is measuring the dollar versus other fiat currencies across the world. So when I say the dollar is weakening or strengthening in relation to this chart, I'm not speaking about purchasing power because the dollar in purchasing power terms is always weakening. When you compare it to a basket of other crappy, endlessly printed fiat currencies, when it increases in strength relative to those, that doesn't mean you're actually able to buy more stuff. So one example, a good analogy is people always say the dollar is the least stinky shirt in the pile. It's all dirty laundry, and you don't want to be doing it in your front yard. But that's what we mean when I say the dollar is weakening or strengthening. I'm talking about relative to these other fiat currencies. So in this chart, this dates back to late 2016, early 2017. I have this white line here over on the left. This is the first year of Trump's first term back in 2017, first time he won the presidential election. And here we have the current right now. This is 2025. Now, the common denominator here is dollar weakness. Trump wanted the dollar to weaken relative to other currencies for a variety of reasons. It strengthens the United States' ability to export, which is what a lot of the tariff kerfuffle was about earlier this year, making the U.S. a manufacturer again. It's hard to do that when the dollar is strong relative to other currencies, so he needed a weaker dollar. But furthermore, he needed rates down. Getting rates down, having a weaker dollar helps with that. Because when rates are high, foreign investors are going to say, hey, I'm going to buy dollars so I can buy US treasuries and get that 5% quote unquote risk free yield on that. So that was one strategy there. Now, it hasn't worked in terms of getting interest rates down, but it has worked in terms of getting the dollar down, getting the DXY down. Now, I've talked a lot about this dollar weakening period from 2017, but if you're a Bitcoiner, remember what happened in 2017? Of course you do. This is the year Bitcoin made an absolutely parabolic move. Now, I have this here in log scale, but in 2017, Bitcoin opened the year around $1,000 a coin, and it closed the year at nearly $20,000 per coin. That was a 20x in 12 months, and it was on the back of this weakening dollar because Bitcoin, we measure its price in terms of dollars, BTC over USD. And when the USD component of that was weakening, it provided tailwinds for BTC USD to rise significantly. You can even see here in the inverse in 2022 when the dollar strengthened, when we had negative M2 growth, when Powell hiked interest rates. During that period, well, of course, Bitcoin drew down because the dollar was strengthening. But now we're seeing a new regime of dollar weakening, and this is going to be massive for Bitcoin. When we look at this chart here, I'm going to move my face again. This is Bitcoin charted with global M2 and the year-over-year percent change. Now, we've looked at this chart a lot of times in various different formats in our videos here on this channel, but the story remains the same. Bitcoin is the most absorbent asset of global liquidity. I'm going to say that again. Bitcoin is the most absorbent asset of global liquidity. So when the supply of dollars increases, Bitcoin is the biggest recipient of that. Those new dollars find their way into Bitcoin. Now, they're going to have an even easier time finding their way into Bitcoin now in 2025 because we have ETFs, because we have hundreds of Bitcoin treasury companies in all sorts of different financial jurisdictions in the United States, in Japan, in Hong Kong, in UK, in Germany, etc., etc. There are a plethora of vehicles for new liquidity in the fiat system to find its way to the Bitcoin system. And so, this relationship that Bitcoin has with global liquidity, I believe, is going to become even tighter. They're going to become even more correlated, which is hyper bullish for Bitcoin. Because, as we've discussed in this video, and as Treasury Secretary Scott Bessent knows, growth, quote unquote, must happen, which means nominal GDP must rise, which means we must print money. There must be a lot of spending in order for M2 to increase so we can get debt to GDP down because we passed wartime levels. This massive spike over here, that was from World War II. That was from all of the debt racked up to finance that war. We are at an even more conspicuous position here today in 2025. So, all of that being said, what can you do? How can you protect your purchasing power? Well, you need to be acquiring Bitcoin. What is the most capital efficient way to acquire Bitcoin? Because you can go out, you could buy one Bitcoin today for about $105,000. Well, you can mine Bitcoin much cheaper than it costs to buy Bitcoin. Let's look here at the Blockware marketplace, which if you go to marketplace.blockware.solutions.com, you can start mining Bitcoin today. We have machines already plugged in. You don't have to wait months between making a purchase, building out a data center, doing all that stuff. You buy a miner, it's online today. You're stacking Bitcoin today. Now, there's kind of four main reasons you would want to mine Bitcoin. First, like I mentioned, it is a Bitcoin accumulation strategy. The best approach to Bitcoin is to take a long time horizon approach because on a day-to-day, week-to-week, or month-to-month basis, Bitcoin can do pretty much anything. Nobody necessarily knows what it's going to do over the next month. However, over multiple year periods, Bitcoin has been straight up and to the right. Look, it's volatile, but over the long term, Bitcoin just goes up and up and up. So, with that in mind, considering the fact that you need to take a long time approach, mining makes a lot of sense. For one reason, it strips a lot of the emotional decision making out of it. You're buying Bitcoin every single day when you're mining. This machine is on 24/7, earning you Bitcoin every single day. It's a very hands off way to kind of separate your emotions from the market. Hey, I'm just going to mine Bitcoin because then I can get it every single day, whether it goes up or down. I'm not sitting here trying to time the market and sweat this. I'm just stacking sats. The second reason is over multi year time periods, mining has consistently acquired more Bitcoin than buying it directly, either in a lump sum or a dollar cost average, because miners are producing Bitcoin at a discount. It costs over $100,000 per Bitcoin right now to buy it directly, but miners are producing it anywhere from $55,000 a coin to $75,000 a coin, depending on the machine they are using. If we go here to the Blockware marketplace and we look at the S21 Pro, it costs $58,000 to mine one Bitcoin. So their effective buy price, if you're using this specific miner at the Blockware electricity rate, is 58K. So you want to get Bitcoin at 58K or 105K. It's kind of a no-brainer. Now, the second reason you might want to mine Bitcoin is for the tax benefits. Now, there's this bill in the House that's very likely to get passed called Trump's Big Beautiful Tax Bill. I'm sure you've heard of it. When this bill passes, you will be able to depreciate 100% of the cost of a Bitcoin miner in a single tax year. I'm going to say that again. When this bill passes, you will be able to depreciate 100% of the cost of a Bitcoin miner in a single tax year. So let's say the end of the year rolls around and you have about $100,000 in capital gains. You can purchase $100,000 of Bitcoin miners and write all that off. Now, consult with your tax attorney first before making any decisions. I'm not a financial advisor, but this is something to consider. And even if this bill doesn't pass, you can still write off 40% under the current tax law as it relates to accelerated depreciation. So, lots of benefits here that are not present with buying Bitcoin directly. The third is cash flow. Like I mentioned, you're stacking sats every single day at a discount. Cash flow has been a hot topic within the Bitcoin world. If you want it and you want it in a Bitcoin denominated way, mining is your best bet. I like to call it SATS flow because every day you have positive Bitcoin denominated cash flow. With other businesses, when the Bitcoin price increases, your Bitcoin denominated cash flows decrease because everything is dollar denominated. If you're making $1,000 per day in cash flow with some other business, the Bitcoin price doubles. Now, instead of making 0.01 Bitcoin per day, you're making 0.005 Bitcoin per day. You understand that? But with mining, when the Bitcoin price increases, your Bitcoin denominated spread increases. So, for example, if we look at this S21 Pro, we Bitcoin denominate all of this. Right now, monthly profits on this are about 0.005 BTC. But if the Bitcoin price doubles, your electricity rate, which is your only operating expense when mining with Blockware, that is fiat denominated. That is, let's say this is a 3 bundle of machines. The monthly electricity rate highlighted here is $611 per month. Now, if the Bitcoin price doubles, Bitcoin denominated, this is going to fall. Your Bitcoin denominated profits are going to rise. So, Bitcoin denominated cash flow is one reason you want to be mining. Now, lastly, let me move my face again here, is asset appreciation. The price of Bitcoin miners, which are effectively money printers, they can change. They're volatile, just like the price of Bitcoin. In this scenario I've outlined where the Bitcoin price doubles, again, let's look back at 2020. By June of 2020, Bitcoin was at 2,000, and then it went to 20,000 by November. It's a 10x in 5 months. Bitcoin does crazy, wild things. If that happens again, you better believe the price of ASIC miners is going to increase very, very dramatically. So the Blockware marketplace, not only does it allow you to buy miners, it actually allows you to sell miners too. So if the price of ASICs increases, you could capitalize on that volatility with this platform. So what can you do? How can you get started? Well, like I said, you can go directly to the Blockware marketplace and you can purchase a machine today. You could pick out any of these hundreds, thousands of miners. Or if you want to talk to someone, mining can be daunting and it's pretty niche. I like to say it's a niche within a niche. So having someone to consult with can be very helpful because the specific miner that's best for you will vary a lot on your market outlook, your current financial situation, and your financial goals. So you can schedule a free 30-minute consultation with one of Blockware's mining experts, and they'll figure out if mining makes sense for you, your position, and your goals. And if it does, they will create a tailored, customized strategy for you. So sign up for a free consultation. Go to mining.blockwaresolutions.com/consult. The link is in the description. Again, that is mining.blockwaresolutions.com/consult.